And may I request the audience at the back to just come forward, please? Okay, so I think we have all the panelists on the stage now, so we look forward to an insightful discussion. So I'll have Noemi, over to you to lead the discussion, please. So Noemi, you can begin.
So, good morning, everyone. I'm very pleased to moderate this panel together. Um, Responsible lending is not only an ethical imperative, right? It's essential to manage portfolio risk, to maintain credibility of organization, and to sustain inclusive growth. Over the last year, we have seen high growth, high competition, which put client at risk of over-indebtedness. At the same time, high valuation put pressure on profitability and spur further growth. And high NPL ultimately put focus on collection and put further client at risk. Particularly when we talk about MFI, servicing low-income population comes with a duty, a responsibility. And it's critical to address responsible lending, to ensure responsible lending, to ensure sustainable growth. Today, with our panel, we will be drawing on global experience to assess how we expose potentially clients to over-indebtedness. The panel we have today, thank you for introducing the panel, at least that spared me to have to put a French accent on your name. We draw on experience from various esteemed panelists to put a critical eye on how we can improve. We'll be assessing the guardrail set by the sector, by the regulator, by investors to protect clients. So let's directly address the elephant in the room. Let's jump into the topic. Aditya, I would like to ask you, how prevalent and acute is over-indebtedness in India today, and are we doing enough?
Sure. Thanks, Naomi. Yeah, I think to get to the crux of the matter, I think there is definitely more over-indebtedness today in India than there has been, in recent times. It's a function of, as the market has become more digitalized, as access to financial services has increased, so I think the sort of it is an unintended, perhaps even undesirable consequence that the access or the ease of access that the financial system has created also risks, over-indebtedness because you have multiple players, easy access to credit, and I think that has happened over the last 3-4 years, especially post-COVID, with an abundance of liquidity in the market. And now the question is, have we done enough? I think the other side to it is the regulators in India, the market in general, is quite responsive and in general self-correcting. And I think we have seen an impact of that in the last 12 to 18 months, where growth rates have slowed. People have started recognizing portfolio quality issues that they are currently facing, and that is translating into numbers. So I think, have we done enough? I think we perhaps have, we did act, but maybe we acted a little later than what we should have. But I think the outcome or the direction is pretty clear. The direction is one of correction and consolidation, or has been so for the last 12 months. And I think this should set us on a sort of a better platform for the coming 2-3 years of more stable and calibrated growth rather than liquidity-driven growth that we saw for between 22 and 24.
Thank you, Aditya. Prima, I think you have a very interesting experience as well. Maybe you can bring us a more systemic perspective, and if there is any more granularity, can we apply a blanket approach when we talk about over-indebtedness? Do you see some segments, some regions that are more affected?
Thanks, Naomi, and thanks for having us today here. Um, of course, we've seen that the smaller ticket sizes are the ones which are facing the higher indebtedness. As Aditya put forward already, that availability of a lot of liquidity in the market did end up putting a lot of the similar customers in the indebtedness. And in terms of segments, of course, we've seen two segments of customers who are coming in this. Specifically, the MFI is already seen, and I'm sure Sudhir will speak more about it because he comes from a large experience on this, but also the unsecured MSME segment, which was either the graduated MFI customers who are now first-time single borrowers, and this kind of segment where there was no collateral attached to the underlying borrowing that was done, did see a lot of, the market did get swayed because of the availability of cash. It could be multiple reasons, of course. The reason could be the underwriting capabilities, the data availability. A lot of information or the credit decisioning was still being taken. This is what you see and not what you could concur from available information that is there. We still, while there is enough data in India and India is known for it and we're working towards it, I think we still need to build stronger data points which could add to the credit scoring. But at the same time, I think at a responsible lending and responsible borrowing, as what you put in, is much needed in the country. I don't think so. We are still there. With each cycle of error that is happening in the market, we are learning. Good thing is that the losses are becoming lesser, but new use cases are coming up with every cycle loss that we're having. So that's something that we should definitely do.
Thank you, Prima. I move to you, Sudhir. You can bring some insight from your experience also in designing methodologies, framework, as Prima set forward about the importance of data. Maybe from your experience, from the data you have seen, what are, according to you, the root cause of the issue? We can't really address the issue if you don't understand what are the root cause. Can these be internal, external? What can you help us and shed some light on, maybe bring us a more ecosystemic understanding?
Okay. So good morning, everyone. Thanks, Access and Incofin to allowing us to be part of this important discussion. If you look at Indian microfinance sector for the last 25 years, this is the first time Indian microfinance sector is facing an internal risk, which is over-indebtedness, which is inbound because external factors, the microfinance space in Indian markets have withered out much strongly. Maybe with COVID or maybe demon, maybe it's Andhra Pradesh crisis, maybe or different state-wise crisis. But this, for the first time, my Indian microfinance sector is facing an internal problem. And that internal problem is basically because of a lot of challenges within the space. There are segmentations, if I put it, Indian microfinance space as larger microfinance institutions, mid-size and small-size institutions. Now, when a Indian microfinance sector start moving forward, starting 2022, when the cap was removed, RBI was very vocal about accommodating microfinance sectors, comparing with banks, other NBFCs. And Reserve Bank of India has always been proactive in terms of saying that we want to grow this sector, we want to put things in place, we want to see that the growth is, much more normal. But starting 2022, what has happened? Starting 2022, banks, NBFCs, large NBFCs, everyone started looking at the same set of borrowers. The borrower base has not increased, the ticket size has increased. Microfinance institutions started looking at the bottom-up approach. There is a cap given by the RBI. They said that you have to work within this. Microfinance institutions start looking at what is the amount I can disburse. And we have seen on ground that a single borrower is having 9 loans, 10 loans from different microfinance institutions, which was not the case prior to 2022. And that gives a signal stating that there is some significant area of improvement which microfinance institutions themselves have to do when they are selecting a borrower. Now, when we speak to the management of these financial service providers, they say that if a larger microfinance institution is lending to a borrower and mid-sized to the same a borrower, they are not fulfilling the criteria. Therefore, the C mid-sized small MFIs also lend to them. But A and B have a capital cushion to absorb the losses. B and C may not be having the capital cushion to absorb the losses. So that's the challenge today in the market space. Now, if you look at RBI's commentary on household income or on underwriting processes, it is very, very clear that RBI wants that the process has to be determined by the governing board and that needs to be implemented on ground. On paper, it looks very, very robust. On ground, it is very weak. That's the analysis what we have seen in visiting different states in Indian markets, different financial service providers, maybe large, small, and medium. And therefore, it's up to the financial service Indian microfinance SROs and Indian microfinance players to see that how they can put a full stop. The guardrail which has come over of 3 lenders, MFIN and Southern has worked on that, will take some time. So over-indebtedness will be, our understanding is that it will be still a couple of quarters away, things will become more better. Maybe by March 26, June 26, things will start improving. But we can see some more storms coming into that till that space, till that time. I think I'm able to address.
Thank you, Sudhir. Danet, I move to you now. You can bring us a global expertise. I would like to ask you from an investor lens. How do you assess an over-indebtedness issue, and how do you ensure responsible lending? Which best practice you can draw from other markets eventually about the most effective measure to address and prevent over-indebtedness?
Yes, thank you for the question. So I think for international impact investors in financial inclusion, the starting point for assessing client protection is the SMART campaign. And what is very interesting about that is that the SMART campaign was created in 2009 as a response to the Andhra Pradesh crisis, where the concern was over-indebtedness has arrived and we need to protect clients. And almost 2 decades later, we're back at the starting point. And what it tells us is that client protection is very complex, and it's still something we're trying to understand and implement on the ground. So I think that's a very interesting situation we're in. So from an impact investor, because we work in different markets, we want to make sure that our assessment is also standardized so that we can look at each of our markets in a way that we can compare and make a fair assessment of the situation. So as an industry, the impact investors we work together through the SPTF platform, which is the Social Performance Task Force, and we come together as an international community to set standards, to create tools that we can then apply and make sure that we're using the same language when we're making assessments, but also that when we're speaking to our investees, we're speaking to them in one common language and not confusing the investees in what we want and what the expectations are. So after setting the standards for the client protection and the principles, this was operationalized through the creation of an audit tool called SPI4, right? And we have created, as a community, as an impact investors community, a tool called Aligness, which is a light version of SPI4, specifically for impact investors to do their due diligence. And client protection is one of the dimensions we look at. And in the case of Incofin, all investments that we do in financial inclusion starts with an audit using the SPI4 tool, the Aligness, and looking at client protection. So it's, for us, a minimum requirement. And this is then hardwired into our loan structure, right, and our eligibility. So to be even considered for investment by our funds, there's a threshold that the client needs to pass. And that's a non-negotiable condition. This is then built into the loan agreements, where we also require that all financial institution investees commit to the client protection pathway, which is a program that's housed under the SPTF Cerise as well. And we require that our investees commit to the client protection principle, that they do an assessment and monitor regularly, but also that they show progress over time. So it's not just a matter of doing an assessment, forget about it, put it back on the shelf, but we expect them to also then progress over time. And so at Incofin, we do that analysis, and what is also very important to us to make sure that we don't compromise on client protection is that we, in the event that we are in an investment or that we're looking at a deal, if these conditions don't comply, we will exit, we will divest from the institution, and we can reject the deals. And there has been cases where we have used this even after having a long-term relationship with the financial institutions. If they are not able to comply or show commitment further, we will exit. And maybe just then on, have we seen over-indebtedness in other markets as well? I think very illustrative is Cambodia, which is a case that has been in the media, and I think every impact investor has felt the situation there. And I think we can draw on a lot of parallels between Cambodia and India, actually. I think, there's three things that we can say is very similar to the situation between over-indebtedness. And I think one of them was what you had said, Sudhad, about the fact that, over-indebtedness is almost that we foresaw it coming, right? Like, loan disbursements was booming in both of these markets, but client growth was basically stagnant. So clients were deepening in leverage. And in India, it's being reflected in the form of multiple loans that you've mentioned. In Cambodia, multiple loans was not such an issue, but actually the leveraging was happening in larger loan sizes that were being masked by increasing tenors of the loan. So the debt service ratio always made it look like the borrower was able to afford it, but it was only because from a 2-year loan, it became a 5-year loan. The second similarity is that what we're seeing and what we've heard from our investees and going to the fields is that a lot of the loan growth at the MFI level is also happening because of refinancing portfolio, right? It's not new loans to new clients, and there is a lot of loan churning that's happening with this refinancing, where the loans taken by the end client or the borrower is actually used to repay other loans. This is something that we see is common. And the third thing that you've mentioned as well about the regulatory relaxation, it was very similar in Cambodia, where, while in this case, in India, the regulators were very active, but they decided to kind of relax it, to move the responsibility to have self-regulation. In Cambodia, the relaxation was on the side where the industry and the Microfinance Association was working hard to self-regulate to avoid intervention by the regulators. But the emphasis was always on self-regulation. And I think maybe what we're seeing here is like maybe self-regulation alone is not always the answer. So there is a fine balance that needs to be considered in that as well.
Thank you, Danet. Very interesting. Again, highlighting the importance of making sense of the data. Data don't lie ultimately, so getting into more granular analysis is critical. But we have learned very much from all these experience, and also here, international standards, they help to speak the same language, to harmonize what we mean by responsible lending. Maybe I'm switching back to you, Sudhir. How adherence to this international practice, like the customer protection principle, strengthen consumer trust and organizational resilience? Can you tell us a bit more about the CPP and learning from, also from a rater perspective?
Okay, so the client protection certification, as mentioned, it started somewhere in 2009. It took place between 2015-17. Uh, if I put in Indian markets, very large ones and mid-sized ones have gone for CPP or client protection certification standards. Mid-size and small size have not gone for certifications. Because way back in 2013, RBI came with code of conduct assessments for microfinance institutions in India with SIDBI, and that has helped to some extent to address the code of conduct or customer complaints mechanism. But that has not, in the last couple of years, that code of conduct is not in relevance because only few lenders are looking at code of conduct. Now coming back to CPP, client protection standards, client protection certification, client protection principles, given the change in market conditions, we believe that there are some standards which needs to change, which needs to modify based on complaints, customer feedback. MCL did an assessment in 2024 with FMO in Bangladesh and Philippines, and just to check what is the pulse of customer. And there are noises coming from the ground stating that something is not right, something needs to be fixed, therefore the standards needs to be revisited, couple of standards needs to be revisited. Based on that study, any assessment going forward starting 2023-24, MCL started looking at much more deeper understanding of clients whenever we are doing a client protection certification for an organization or an assessment, which has given us an input in Indian markets. I think Indian markets we have done around larger ones. We are having a response of around 500-600 borrowers, including the default borrowers. We suggest that some standards needs to be revisited, some standards needs to be looked at from the changing market conditions as well as the feedback coming from the customer. So resilience is slowly building up. We are putting owners in Cambodian markets. We are very aggressive. I will not say aggressive. We are very active in Cambodian markets from the MCL point of view. What we are doing there is that we are having a ecosystem joint stakeholder meetings where National Bank of Cambodia, CMA, ABC, financial service providers are coming together and addressing the concerns. Same thing will happen in India too, is what I believe. That we had a discussion with SROs a couple of days back on this topic, and hopefully we will see that's taking shape, and some kind of indicators will help to build a much more stronger, resilient customer protection mechanism in these countries, which will be spill over to other countries, I'm sure, which will go to the other countries too.
Very interesting. We sometimes say don't waste a good crisis to learn. So I think there are much more lessons, and we'll go back to these lessons learned afterward. But maybe let's move back indeed a bit from Philippines and Bangladesh to India. And I turn back to you, Aditya, again. So a key difference also that we can observe with different markets also is the role that the RBI has played also in setting up guardrail measures, framework in order to address, prevent over-indebtedness, but also to protect client. And from an investor perspective, again, Aditya, how effective are these standards in protecting client?
Sure. Yeah, I think. Well, I think here is where sometimes the opposing interests of being an investor and client protection come in. I think the client protection measures in India have been effective, but the cost of that has largely been borne by investors, unlike in case of Cambodia, where, for instance, I mean, some differences. Cambodia had 30% return on equity in dollar terms. Nobody in India ever had no MFI has ever had 25% even in rupee terms return on equity. So the profitability was very different. Second, I think as Daniel rightly mentioned, in India it's more about multiple loans rather than over-indebtedness. Even despite all that, if you look at the average loan balances in India, they were 1/5 or maybe 1/3 of what they were in Cambodia. And this, when India has a higher per capita income, than Cambodia. So the level of over-indebtedness in Cambodia was very different from what we saw in India. So I think the measures have been fairly effective and also timely because, I mean, maybe a bit delayed than what one would like. But if you look at the trajectory of how the RBI has played a role, I think they have played a very considerate role. So initially there was an interest rate cap between 2012 and 2022 thereabouts, where the market was still quite nascent, and so that external control of pricing was necessary. And then the RBI felt, rightly so, that there is enough self-correcting mechanisms in the market, there is an SRO, there are enough players, and there's the likelihood of extraction or overcharging is low, and then they move to sort of not let go of controls on pricing. But then they again saw that was combined with excessive liquidity from post-COVID years. And to taper that down, again, there has been a fair amount of intervention in the last couple of years. And again, so a lot of the losses that we have seen on account of weak underwriting are on the balance sheets and are passing through the P&Ls of the investees and being absorbed ultimately mostly by the shareholder, and in some exceptional cases by the lenders. So you don't have that many distress cases in India, perhaps as in proportion in other markets. So yes, I think there are problems. This is a big country and it's hard to regulate. But overall, on balance, I think the direction has been correct. And there has been self-correcting mechanism in the country, also helped by the RBI.
Thank you, Aditya. Indeed, the engagement of the RBI has also helped to tame that growth, and that's one, maybe if we need to highlight one key difference with Cambodia is as well that the market hasn't been able to tame the growth in Cambodia despite all the alert on over-indebtedness, multi-borrowing, and that self-correction is quite healthy, even if at the cost of shareholder and investee to some extent. But even so, the RBI has called a lot of NBFI as well, NBFC, sorry, and MFI to tighten their underwriting standard. But is increasing the rejection rate the only answer? The question maybe is, could we do more on the borrower side? And I turn to you, Prima. We had extremely insightful discussion yesterday. How can we ensure that both the FI but also the client are learning the lessons?
So first of all, I go with what Aditi just mentioned. RBI is a regulator for us, and I think somewhere he ensures that our growth without the customer suitability is kept on check, and it's just not a business risk, it's also a regulatory risk for us. As lenders, we are really scared of the father, and we are ensuring that compliance is one of the key core elements. Governance is one of the key core elements when we are either assessing our own policies and processes, but also when we assess when we are approaching any possible lender, borrower. But rightly said, I am a thorough believer that the stakes is for everybody. It's just not the lender's responsibility. While it starts at our end, that it is imperative for us to have the right policies, to follow the client protection, the 7 principles, rules. But if it is just unidirectional, eventually all the cycles will keep breaking. It is important that the customer should also realize the importance of their responsible borrowing in this segment. And it could be through trainings, it could be through disciplinary actions, where we protect all sides of the stakeholders, in the lenders and the end customers. Of course, a lot of work has gone in financial literacy, financial education, but it is also possible for the consumer through mechanisms of creating samples within the within the country, where they get adequate information of what behavior or discipline is needed for their future borrowing. Their small efforts will be needed so that the market stabilizes eventually. And also, it will set examples for the new customers coming up. We've seen through data that the NTC has really come down. The new to credit customers have really come down. The denominator is still the similar set of customers, and because of which they over indebtedness. As lenders, we are scared to absorb new customers who have not adequately learned what is borrowing. So it becomes the responsibility of these borrowers, because if you do a mistake today and you think it's okay to settle the loan outside, then your neighbor will also learn the same. We have seen this specifically times when some of these loans get waived off at a mass scale. It's not a good practice for a growing market to set this kind of examples, because then you're only setting up future losses for investors, lenders, and probably the market itself.
Interesting. If we resume, if I may, if we resume growth now, ignoring the lessons and not incorporating these lessons into the lending methodology, we may end up in this panel in 3 years' time and repeat the same thing. So how can we make sure maybe we can accelerate now financial literacy as well? And this specific awareness is critical to make sure that
Absolutely. I think financial literacy, and also, of course, a lot of effort over the last 3 decades have gone in making sure, of course, through the MFI route in India specifically, on bringing, larger customer availability of cash, availability of loans have increased. But now it is about responsible literacy.
Yeah, and especially given the strong community role of many of these institutions are playing, that facilitates as well. Yeah. Going back again from a global perspective and drawing lessons, Danet, I look at you. What can we learn as well from Cambodia about how we can adjust also this practice to incorporate all these lessons?
Yeah, I think Cambodia is a very interesting example because there was a lot of collaboration between the microfinance institution, between the microfinance association, which is equivalent to the SROs here, between the international lenders and the standard setters. So a lot of efforts went into Cambodia to try to tame, as you mentioned, the over-indebtedness and deflate the bubble, which doesn't always make it to the headlines. So I'm happy to share. There's 2 innovations that came out from all of these efforts that I think could be interesting for India. One is linking to the financial inclusion, the literacy that you mentioned, the responsible financial literacy. What Cerise and SPTF is piloting in Cambodia now is a new way of delivering financial literacy. So the traditional way of doing financial literacy has been on preventing over-indebtedness, teaching clients or end borrowers on how to manage their finances, but it stops there. There's no further efforts, or there's a gap in then considering the situation when a borrower is actually in stress. So what they're doing now is moving from just plain vanilla financial literacy towards customer empowerment. And so the focus with that pilot is on trying to build confidence of end borrowers to know what their choices are, to know what their options are, so that they can feel like there's a path out of over-indebtedness. And what is interesting about that pilot is the way they're delivering it. So instead of using consultants from outside to teach this, they're using a peer exchange delivery. So it's people in their villages, in their neighborhoods who have fallen into over-indebtedness. They are sharing their experiences with people who are currently in stress and helping them understand the situations and how to get to resolve it, how to negotiate with the financial institution. But what this is kind of interesting and changing is, as you mentioned, Prima, is, client protection is on the side of the borrower. We need to also make sure that there's an attitude change or a behavioral change about the risk of over-borrowing. And This needs to happen in the form of imitation with other borrowers. And so this kind of pilot testing is trying to understand how that would work, and I think it could be, a new way of then providing this kind of cultural change to make sure that we balance. It's not just over lending, but also over borrowing. The second innovation I think is very interesting is what I had raised about the refinancing risks of microfinance institution, where they're just refinancing instead of finding new clients and providing new types of products. The problem with that is some refinancing is good, right? It's needed. Some refinancing is not good. It's risky. But it's very difficult to know what it is. And that's what in Cambodia we understood. And so in COFIN, we spearheaded a project with financing from FMO, as well as Proparco and BO and ADA back in 2016, at a very critical point, because in 2016 was when Cambodia created the credit bureau. So for the first time ever, data on loans were being consolidated from all financial institutions in Cambodia, and some of this interesting work of consolidating, breaking down, analyzing could happen. And so what we did was using the credit bureau data, with the help of the credit bureau, to automate these reportings or these dashboards that would then identify at the microfinance level what part of the refinancing is risky. And there was an interesting finding on defining what is risky refinancing that came out of it. I'm happy to explain more if we have time, the components that are looked at to determine what is risky and what is not risky refinancing. But the outcome of that dashboard was then flagging what is risky. And the benefit that came out was that it provided a better picture to everybody, from the regulators to the investors to the microfinance, on where the risks really are. And it also helped us differentiate between the players that were very aggressive. So if they had a high risky refinancing, those are the ones that were kind of signs that, please stay away, they're conducting very irresponsible in the market, and clearly differentiating the ones that were doing responsible refinancing. So so that was a second learning that was interesting.
I hear also about the importance of collaboration here, and indeed all the actors in Cambodia, India, they share one ultimate objective: is inclusive, sustainable growth. And maybe going back also to you, Aditya, what we have seen typically when there is a strong focus on collection and recovery after such a crisis, these increase reputational risk. Very often, bad media are pointing at doubtful collection practice, and that has been very much the case in Cambodia. For various reasons, we won't enter into detail, but how robust are the recovery framework they are already implemented in India? And maybe can we do better to ensure a responsible collection?
Yeah, I think again. So I think in the earlier crisis, for example, in case of Andhra Pradesh, there certainly weren't enough safeguards as far as collections were concerned, and there were excesses committed perhaps a decade and a half ago. But again, I think it's been part of a learning process in India now. While collections have increased, I think the field staff is much better trained than they were perhaps a decade ago. Now, that said, we can't afford to let our guard down as far as training of collection staff is concerned, because this is a very high turnover business where 30% of your staff are leaving every year if you're lucky. Perhaps it's even higher in more competitive years. So there's always this conveyor belt of new young employees coming in who may or may not be sufficiently trained and be sensitized, who may not have a historical background of the sensitivities of collection. So I think that we have to keep an eye on the ball at all times. Again, one other difference between perhaps Cambodia and why that has become much more of a reputation risk there versus India is the microloans in India are largely unsecured. And given the unsecured nature, there is no land title or collateral that gets involved, and that becomes quite sensitive. And a lot of the distressed cases in Cambodia are driven from forced land title sales and so on and so forth, is what one gathers from the media. I think so. That gives a bit of respite. Also, I think, look, India is fundamentally, a very functional democracy. So if there are excesses, it very quickly snowballs into a local political issue, and that has sometimes with vested interests, sometimes more organically that happens. So that also sort of acts as an early warning. I mean, while we say when democracy sort of is a pressure valve that releases some of this stress, also plays a role in the Indian context, based on my experience.
Again, no silver bullet solution, but what we can say is that strategically moving from unsecured to secure lending is not the only solution, because ultimately, in time of distress, you need to ensure that you have a responsible enforcement of that collateral, and that's another lesson we have learned from other markets. I look at the time. We started a bit later, but I think we want to take some questions. So maybe I will try to conclude a bit this extremely insightful discussion. You reminded us also about the crisis in 2010 in Andhra Pradesh, and we can name a few observations of cycle. We've seen that India has a bit of a history of blowing cold and warm, and learning from these different crises. And post-COVID, we all came up with this resilience topic. It was all about resilience. But now more and more we hear about anti-fragility. And what does that mean? It's not only surviving the crisis, but getting stronger from the crisis, right? So maybe I would like to ask you a call of action. What can we learn to make the sector more anti-fragile? What will be your call of action?
One core action that I can think of is to get our intentions right, and also along with that, ensure that the underlying data pool that we are creating is adequate, so that we put the right product in the right hands, and not just create a product and sell it in the market, so that it ensures that the over-indebtedness that we've been speaking about, the client protection that we've been speaking about, is taken care of.
Okay, so if you look at Indian markets, I think I'll touch base upon 2 points: reputational risk as well as the resilience and other factors. Reputation risk as an organization, reputation is core for us, because at the end of the day, we are assessing an institution. We are doing all kind of practices, all important practices which is required. And if we are going wrong, the responsibility lies with us. So what we have done, we have started working with various stakeholders across the ecosystem and see that whatever processes, policies followed by the FSPs are in align, and how they can improve the market based on market changing conditions. Now, Indian markets may move towards secured lending, because 60-40 is the ratio which is given by qualifying, non-qualifying assets, which may push the Indian financial service providers to look at assets which are hypothecated or mortgaged to be, if a situation comes, that how you can repose that. But more importantly, based on our internal study, there has to be much more focus on customer understanding the complaint mechanism. Currently, the customer, if you ask the customer, how do you want to complain if there is ABC happening? The customer will say, I'll go to the loan officer or to the branch manager. They will not look at the hotline number, or they will not look at the central whistleblower number. There is a fear in customer space saying that if I do that, then I may not get credit from the lender or from any other lender. So that fear needs to be taken care of, and that's the message which we got from Indian markets, and that's the message we got from Cambodian markets. Now, how we can address this? The address is that within the ecosystem, we have to see that can there be a mechanism built from the SRO in India saying that what are the complaint mechanisms, how effective are. If when we're doing a certification process, if we ask how many complaints have you registered in 6 months or 3 months, there are hardly 100, 200, 400, 500 customers. The customer base is huge. And then we ask why, then they say that they are interacting with the loan officers, therefore it is not recorded. So one of the area where MCL is working is that can we put a much more robust complaint mechanism and how that can be accountable for an FSPs at regular monitoring, understanding that are they doing a survey of saying that do they understand what is complaint mechanism, how they can complain it, what kind of complaint mechanisms are in place. So with this, I personally believe that whatever happened in Indian markets in Karnataka or in Andhra Pradesh will wither out to some extent, and new challenges will come in. So we have to work as an organization. We have to work with all the stakeholders to see that what is important for them and how we can address that. So it's an evolving market for us, and it will evolve because digital will be taking much more shaper, much more stronger focus going forward. So we need to keep evolving. We need to keep challenging ourselves on the framework. So that's how we can build a robust system across the financial service providers.
And thanks for putting back again also the loan officer into the picture, because that's something we didn't touch, but I think it's important to work at all levels of the organization. If we talk about client, investor, that's very important to remind. They're the first one to implement the right responsible lending practice. Maybe your call of action, Danette.
My call to action would be to do research to understand the unintended consequences of the regulation tightening. I know it's always with good intention to deflate the market, but what we're also hearing from talking to the microfinance players and some of the consultants is that, and what was already picked up during the conversation is about, the shift of moving towards secured lending now. We need to understand those trends a little bit better and what that could mean in terms of responsible practices. What we also had heard related to the unintended consequences is the impact that this have on gender, because the metrics on including the household income is that, in what we've heard is that usually the husband would have a larger loan size to cover more kind of fixed capital or other activities that then eat up that quota that is could be used by women for their businesses. And so the unintended consequences could be that the financing to women is actually going down and then pushing women more into financial exclusion as a consequence of this rule. And I mean, the third point that may need to be reviewed under the unintended consequences is whether we're actually moving over indebtedness into the shadows, as what we've seen in the ground after visiting this week with the microfinance institutions and the branches and the loan officers is that they are rejecting more applications, right? And so when they're rejecting these borrowers, is there a risk that these borrowers are then going into informal borrowings, and that this cannot be captured right now because there's no reporting to the credit bureau or anything like that? So I think that would be interesting to know that and make sure that, while everything looks good, in what we can see, there's things that are going underneath.
That joined a bit the point of Prima as well. Huh? Having the right intention, the right data is critical to identify this blind spot, and the right product ultimately. and that will unlock really the power of collaboration that we have seen already happening in India, but that can take it one step further. Aditya, leaving the last call of action for you.
Okay, so I think my co-panelists have given very specific points in terms of call of action. So maybe since I'm going last, I think let me perhaps conclude a bit on a philosophical note in the Indian context. We have the concept of Brahma, Vishnu, and Shiva, which is the creator, the preserver, and the destroyer. So I think this cycle will go on even in our sector of creating new, of preserving it, and then destroying, and then again creating, again. So the concept of time being cyclical in this country. So the point is to make the transition between these phases as smooth and painless as possible. And I think that's something for all of us to be conscious and be more deliberate at going. But I think it's very hard to escape that whole cycle of creation, preservation, and destruction, and then repeating again and again.
Not destroying too much, I hope. Thank you. I think we are getting closer to the end. And you said earlier, and I like this word, and I would like to repeat, we cannot afford to lower our guard, because reputational risk ultimately translates into business risk, liquidity risk. Maybe a question for a further panel would be, how is lending resuming, or maybe next year, how we will be observing how lending has resumed in India. But I like also to highlight, we have seen today, it's also a regulatory risk. And that's important to remind, and that's again going back to the power of collaboration, because responsible lending is a duty from all the actors, from investor, NBFC, MFI, regulator, and together I think we can. There is a lot of promise to sustain inclusive growth. Thank you very much, and I'm taking now a few questions. I'm not sure how much time we have for questions. I hear 5 minutes for questions, so don't hesitate to raise your hand if you have a mic to voice it. There is a question just there. Maybe you can stand up so we can find you.
Hi. Yeah. So see, as guardrails are put on GL, but with relaxation on qualifying asset norms, do you see flood of pseudo? IL may lead to over indebtedness, converging into one more crisis soon. And what should regulator SRO do about this? And is there any similar kind of experience for you in other countries?
Maybe Sudhir, you want to take the question?
When we look at the other markets where the individual loans are there, we have not seen that kind of deterioration in asset quality or the impact on growth. Now, if we are putting bits and pieces together, and if you are saying that ABCD needs to be done in a proper fashion and proper processes, I don't see a challenge when you put a guardrail. Guardrail was there in Indian markets before 2022, and it was working fine. I believe most of the FSPs, financial service providers, mostly microfinance institutions, were much more responsive at that point of time. But when you put a process, or when you put certain standards, there are advantages, there are disadvantages. What we have seen in the market when the guardrails were there, that certain FSPs started not collecting the last two amounts, saying that let it be the third lender, let me be the third lender, because there is a fear of losing a client. Acquisition of client is tough in Indian markets or any market, but losing a client is even tougher, so they don't want to lose the market. So when you put a guardrail, even the guardrail now which has come into picture, will have its own impact, it's have a negative impact. But are you able to witness that and try to take a corrective measure at the right time is what we need to check, what we need to see. I believe personally, because we have seen that happening in Indian markets will be able to do that. Because this is the longest time when the Indian markets have been, degrowing. The microfinance space has been degrowing, which is not the case in the past, whether it be Demon or Andhra Pradesh crisis or, the COVID. We have, bounced back very fast. This is the longest time which is the market is taking, and it's a good process to see retrospective, saying that what has gone wrong and how do you want to do it right. So whether it be a guardrail or something like that, if things are taken in a right measure, right corrective approach, I think it's doable. I think I'm able to answer your question.
Do we have more questions? I guess you were very complete and clear. So I think we can close here.
Yeah, sure. So great. I think thanks all the panelists for this great session. I think we covered different aspects from Cambodia to India, and then given the fact that how these two countries are politically different. So it was quite interesting to learn besides the risk management practices. And thanks, Noemi, for moderating this session along with the fellow panelists. So I think we will continue with the sessions without having a break at this point in time because we're running out of time. So please remain seated while we resume for the next session. And then can I just ask the panelists to remain seated for the token of appreciation and photo op. Thank you.
Thank you, everyone, and thank you to the panelists. It was a pleasure.
Sumita.